seeing this now that Indian bond markets and Indian central bank now has kind of significantly decoupled from what's happening in global markets, okay, and specifically developed markets. So because they are facing a different aspect on inflation today also, when you look at inflation in India and US.
You spoke about inflows of to the tune of 75 to 80 billion. So that means a lot of liquidity, by the end of the calendar year. How do you see RBI managing this liquidity? Hello, investors. Welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam, and I have with me our head of fixed income, Devang Shah. Today, me and Devang will be talking about the developments in bond markets, also including the West Asia crisis, the developments happening on that front. What is the impact of RBI measures on Indian bond markets and in terms of macros? So, Devang, let's begin. The last 2-3 weeks have seen some semblance returning to the macros globally. We see a peace agreement happening between the US and Iran. So, if this peace agreement happens and it is effective and it works out the way it is supposed to be, how do you see the impact on Indian macros and the bond markets?
So first of all, you rightly highlighted, I think, a lot of positive developments over the last 20-30 days from the time we spoke last. If you'll ask me, first of all, there is a memorandum of understanding whereby they have actually somewhere down the line come to an arrangement or an agreement that they will first of all open the Strait of Hormuz, remove the blockade, and start somewhere down the line a free flow of oil supply against certain things, which is probably a lot of noise around frozen assets being released, no further sanctions, entire geopolitical attacks getting relaxed. So there are too many conditions. We all need to understand that how all of these pan out over the next few days. But rightly highlighted, oil prices have reacted very, very positively. So from a peak of $110, $115, they are today trending at sub 80, and which is a very, very big positive as per me. Overall, macro for India definitely gets very positive as and when oil prices significantly cool off. So we have seen that. Now, if you'll see, we'll talk about the 3 or 4 parameters which generally impact bond markets and macros. What will be the impact of growth? What will be the impact on inflation? What will be the impact on current account deficit and external situation? I think with the crude settling across, and if crude prices settle between $75, $85 for most part of this year, the inflation figures which are going above 5.5% and close to 6% in H2, we all need to still see how the El Nino pans out. But supposedly if this settles, I think the inflation fears probably might recede back and we will not see the headline going significantly above 5%. That is one big positive. The second thing is about the worry and concern on CAD and BOB, which were significantly getting, I would say, people are getting worried about it, and then a lot of impact of that was seen on currency. Along with the crude settling across, we have a lot of RBI measures. You spoke about this. RBI did a lot of measures in the last monetary policy, and we believe so this will actually lead to 75-80 billion of flows in the next couple of months, or probably by December. So 70-80 billion of flows will somewhere down the line take care of our current account deficit and BOP solution. So whatever deficit problem was there, I think largely is taken care of. And once the crude prices settle here, we see that first quarter we see some challenges on the growth side. But if we are back to below 75 on crude, I think overall growth cycle will not be so weak. So I would say a significant positive development over the last few days, both I would say on the geopolitical side due to the MOU which has been probably signed and entered, and also because of the RBI measures announced. I think somewhere down the line over the next few months or quarters, we'll see a lot of positive changes across Indian macro.
You spoke about inflows of to the tune of 75 to 80 billion. So that means a lot of liquidity, by the end of the calendar year. How do you see RBI managing this liquidity?
So see, first of all, you rightly highlighted that 75-80 billion is a lot of liquidity. So let's look across some of the mathematics on how the banking liquidity is there today. Banking liquidity post the entire RBI dividend announcement, today it is significantly surplus. And we talk about durable liquidity always. It's closer to 5 lakh crores plus. It's a big number. Now we are talking about 10 billion, 100 billion kind of flows, which is closer to another 10 trillion. On a worst case scenario, let's assume 7.5 trillion kind of flows because of all of these measures which RBI has announced. So we are looking at a liquidity of more than 10 lakh crores in the next 3 to 6 months. This is a huge amount of liquidity. What we believe so is, one, there's a significant amount of forward dollar position which is in the short side, which is around 30 to 50 billion. So which will get negated, which will get somewhere down the line set off to the tune of around 3 to 5 lakh crores. Plus, I think if there is huge liquidity and the inflation problem persists due to El Nino and all, RBI might use some measures to remove this excess liquidity. So I would say today we should not be worried about all of these, but we are talking about 3-6 months hence. If this liquidity continues to float in the economy and inflation continues to persist, RBI can actually use reverse measures like OMO sales, CRR hike to actually absorb this liquidity from the system, which can be, I would say, temporarily, which can lead to volatility in bond markets. So near term, no concerns. And in fact, bond markets have given a big thumbs up to both the things. I would say probably the entire MOU signing as well as RBI measures. And we've actually seen bond market yields cooling by 30 to 50 or 30 to 70 basis across the curve. 10-year GSEC, 30-year GSEC is 30 basis lower as we speak over the last 1 month. Similarly, corporate bonds 3 to 5 years is around 50-70 basis lower. Look at the extreme short end of the curve is close to 100 basis lower. So markets have already reacted positively on the bond market side because we have priced in excessive rate hikes and scenarios like that. I think that reversal has happened. If this liquidity persists and we have a dual problem of inflation at that point of time, which continues to remain high, I think RBI can use some measures to absorb this liquidity.
Okay. You also spoke about rate hikes, expectations being built up. Globally, we're seeing a hawkish environment. We expect the US to hike rates. Japan is already hiking interest rates. How do you see the RBI managing this scenario of interest rates in India?
So Shalini, we have always been seeing this now that Indian bond markets and Indian central bank now has kind of significantly decoupled from what's happening in global markets, okay, and specifically developed markets. So because they are facing a different aspect on inflation today also, when you look at inflation in India and US, the gap is almost zero. Like US inflation is currently around 4%, India is around 4.5%. So the inflation is no longer too much of a concern. That is why there's interest rate differential or we will be reacting as much as if Fed starts hiking. That might not be the case. It will be totally dependent on what happens on Indian macros. And as I told you, I think the lower crude prices will probably ease the inflation pressure which we were all facing. But let's come across to what's happening because it is important what's happening on the global central bank side. We have been talking about that we are nearing the end of the cycle. Everyone started talking about rate hikes. Fed will probably do, and I personally found the new Fed governor to be a bit hawkish. So if you ask me, we can see a couple of hikes on the Fed side. Bank of Japan has already hiked. We have seen other Asian central banks also hiking. Will that put some pressure? I would say till the inflation is contained, no. But if we see El Nino, we start seeing food inflation again, and we don't see, and that continues to persist, we believe that RBI can look at rate hikes in the second half of the year. Will it be more back-ended? Probably yes. And this is with the caveat that oil prices continues to remain below 75. If oil prices go up and we see food inflation, I think second half we can see some rate hikes. But this rate hike cycle, Shani, as per me, will be a very shallow rate hike cycle. So bond market investors did not get too worried about it. It is not going to be a long rate hike cycle where probably we'll see rate hikes of around 200, 250 odd basis. We might at max see 75 to 100 basis of rate hikes, out of which currently also 25-50 basis is priced in. So I would say bond market volatility will continue if this inflation persists, but it will be very, very limited.
Okay. One of the actions by the RBI was the tax efficiency measures. Do you see this as a precursor to India's inclusion in the Bloomberg Global Aggregate Bond Index?
So see, we believe that Bloomberg was very keen to add India onto the Global Aggregated Index. So we believe so that the probability has significantly increased with these tax changes, and definitely that will be another surprise and a positive for bond markets, which will probably lead to some rally in bond markets. We expect, and I will assign a very, very high probability of our bonds getting added into Bloomberg indices by September this year.
Okay. How should investors be looking at investing in fixed income funds?
See, Shalini, I think last month when we actually came up with the write-up also on bond market stating that this is a time to probably start entering funds tactically, increase your debt allocation. And actually that has significantly fared well. If you look across it over the last month or so, bond market yields have significantly come lower. Today, if you'll ask me, where are we in the cycle? We are probably, if I look at the next 6 months macro cycle, will probably be slightly lower on inflation than what all of us were projecting. Will probably be status quo on growth and will be significantly flush with liquidity. In such kind of scenario, what we advise client always is to continue to stay invest in the short end of the curve, because this such kind of liquidity, which is 10 lakh crores, will probably all be with banks and lenders. They will indirectly start reducing their CD supply and corporate bond supply. They will issue less of bonds and CDs, which will probably lead to rally in bond market yields. So our perspective is the short end of the curve continues to remain attractive, and what we are telling investors, I would say short to medium term funds. Investors are looking at parking solutions can look at money market categories, and investors are looking at more than 1 year investment solutions should look at short to medium term funds. At these levels, I would probably not be very bullish long bonds, because long bonds have rallied by 30-40 basis. We are at the cusp. There are inflation fears on account of El Nino, so I'll probably be neutral at these levels on long bonds.
Thank you so much, Devang, for your valuable insights. And a big thank you to all our investors. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.